Okay, everyone, welcome to another Deathmatch podcast. I am Dr. OG, and I have a very good friend of mine, Mr. Michael, and I am super excited for this one because this gentleman is all about finances, and I love it. So we got him on. Let's pick his brain and see what we can figure out. All right, Michael, I'll let you introduce yourself. Go right ahead.
Awesome. Thank you. Yeah. My name is Michael McIntyre. I'm a financial advisor with Janney Montgomery Scott, and I'm actually located right in downtown Boston. And I do typically work with really individuals in general, but I have started working with dental professionals, medical professionals as well, especially kind of in their younger years coming out of school.
That's amazing. I love it, and that's something that doesn't get enough talked about when you come out of school. Nobody ever tells you, "Hey, got to know those finances till you get to your 4th year." And then they're like, all right, you got to figure out your life insurance. You're like, what? And then that's the part that is interesting. Well, Michael, tell me this. This is, something I always wanted to know. What is it really like in the simplest way? Like, what is the financial advisor? And what do you guys really do? That's, I think, is a good way to start this.
Yeah, we're essentially licensed professionals who provide investment advice and guidance really on financial lives. And typically, at least for me especially, I like to use a financial plan to really kind of start that journey.
Well, that's awesome, man. So talk to us about what is a financial plan? Why do you think that financial plan is so important? And what is it? Just tell us about it.
Yeah, I like to use a financial plan. I'll try to use some doctor analogies and dental analogies for you guys as well. But it's really kind of that introductory, the first time you're going to get into someone's mouth and say, what's going on here? The same way as if you came to my office and said, hey, I want to start saving for a home or retirement, I'd have to really get under the hood and say, well, what's really going on? What are we doing? So it's really an involving document. We update them typically annually, but we're going to find out what's going on, the expenses of your life, really what's coming in and out, and trying to really do a balance sheet that way. And then really, what are your goals? Are you trying to, some common goals include purchasing a home, a college savings for your children, possibly, and then also typically retirement. So those are kind of the three major ones. But in addition to that, while we're kind of trying to accomplish those different bucketing strategies, we also want to kind of go beyond those and say, well, how's your insurance? Are you covered if, God forbid, the worst were to happen? And then kind of as you age, you learn, get more into what's really the estate planning section. But I'll kind of keep that down the road for a different topic, the estate planning.
Yeah, no, for sure, for sure. And then, that's just beside the point of what you were talking about. Like, when you're kind of from the day you graduate dental school to like you're kind of get like deeper into your career, let's say 3 to 5 years out, does the strategy for financial planning, does it change or does it stay pretty much the same?
But yeah, it's an evolving document. So you will get, at least for us, we give you a printed financial plan or PDF actually. But that's changing. That can change annually. So at a minimum, I like to try to update them annually. But it's also up to you. Say, hey, I just bought this new home, or I'm thinking about purchasing this. And so it's always changing, and that's always a conversation. But even just on the investment strategy side, your risk tolerance or your kind of achievements will change too. For example, when you're younger, you have a pretty long time horizon, especially in retirement accounts, to be pretty aggressive on a strategy versus when you're older, you might need kind of more income producing to replace your in retirement.
Got you. And then, so, coming out of the school, I just want to know, like, when would someone really need to look at a financial advisor? And then for those financial advisor, how are they compensated for helping me or helping a medical doctor or anyone in general?
Yeah, I always say it's never too early to start with a financial advisor because, there's just so many different advantages you can probably have from working with one. Typically, a life event's going to trigger it. So, for example, graduating dental school and you're now going to be making a pretty large income, that might trigger it. Um, Divorce could trigger it. Marriage could trigger it. A newborn baby could trigger it. There's so many different events that could trigger it. You could have a windfall from an inheritance, or we've had people win the lottery. So all kinds of different things can trigger that event. But it's never too early to start. It's really, though, you got to find the right advisor, especially kind of given your circumstances. But regarding the different compensations, there's three that I'm aware of. Now, there might be more out there, but one is risk brokerage. So that's really the commission-based products and making commission trades. So you'd call me and we'd buy a certain stock and you'd get a charge of commission. The second I've seen, and this is starting to become a little popular, at least at what I've seen in the industry, is a flat fee. So that's where you pay an annual one-time fee for advice. So for example, if you wanted a financial plan, that might cost $12,000 to develop the plan, and then maybe $500 every time you update it. And then the third option is really fee-based. So that's just getting charged a percentage of assets under management.
Wow, that's awesome, man. That's amazing. And then really the other thing I just kind of tying it up to that, like what financial questions or concern, should you have or you should be asking out of dental school?
Yeah. Also, medical students, especially dentists, are in a unique situation because you just spent the last 8 years possibly accruing debt, and now you're actually going to be making income. So, and according to Glassdoor, general dentists could be making anywhere from $200,000 to $335,000 a year. Now, that can vary, especially depending on what part of the country you're working in and really your individual circumstances. But you really want to create a plan for that new income. So that plan's you want to pay down the debt, and you also want to protect yourself along the way. So I like to say establish a budget and trying to keep that residency mindset, that student mindset of the ramen noodles. Hopefully upgrade your life a little bit better from the ramen noodles, but still really focus on paying down that debt, especially the high interest debt first. You just get that financial freedom to be debt free, and it will really open up a huge path for you. You're making a large amount of income right out of school, but you really should try to use that to pay off any liabilities you have. And then actually talking into that point though would just be an insurance too. So especially for medical professionals, you guys are working with your hands and your feet, you should consider looking into disability insurance. So for example, actually, I had the unfortunate accident of tearing my Achilles last year.
So,
I don't recommend that to anyone. However, I do work for the most part a desk job where I can do my day-to-day behind a desk and on a phone. So I'm still able to work. However, if you were to tear your Achilles, you can't treat any of your patients now. And so that's a really important thing to consider, especially right as you start working, is looking into getting some disability insurance to really protect that income. And then the other type of insurance, which is also going to probably be discussed, especially in the financial planning process, would be life insurance. This one's a little bit more unique. It really would depend on your certain situations. So disability insurance, again, especially you guys being on your feet, you want to really look into that. Life insurance is going to depend on the situation. If you have families and dependents, so if you have children or a spouse that's kind of relying on you and your income, or you have a mortgage or some kind of liability like that, it's probably something you want to really look into. However, if you're kind of on your own, there might not be that much of an insurable asset behind that. But there are a lot of types of life insurances as well. And that's something to really to learn and do some research on, or work with a professional to kind of help you there. Whole life is a very common one, and that's typically the highest cost. And then there's term, which is actually typically the lowest cost. In most situations, especially when you're young and kind of building your net worth still, I would say term is a good option to start exploring first, as it is a lower cost. Threw a lot there. I'll see if you want to dig into any of those subjects a little deeper.
and yeah, no, absolutely, man. I really appreciate it. Well, when it comes to the disabilities, I know that, for example, for myself, when you're applying for this different type of disabilities or like the life insurances, are there any negativity if you have past medical issues, if you have something, if when you're applying for that life insurances, does that cause you to get like denied for the life insurance? If you ever had an injury, if you have medical issues, what are some of the perspective in that?
Yeah, that's a great question. And that is commonly, so if you were to go forward with life insurance or disability insurance, there's an underwriting process where the insurance company is going to look into your medical history, exactly what you referred to, and see if there's anything that would make you an at-risk for coverage, which would essentially mean triggering something. So those types of things could disqualify you. They could increase your premiums and the cost. It's on a case-by-case situation. Some insurance companies take on higher risks than others. That's really would have to get specific, but it is something to consider that can definitely cause some hiccups along the way.
And are there any differences if you're like a medical doctor, if you're a dentist, if you're like a surgeon? Is that like a different, or are they pretty much the same all across?
For the disability insurance, actually your specific type, even your specific type of dentistry could cause changes in, and especially given your income, could all cause changes in the coverage. Life insurance, not as much, but also that could still be a factor as well.
That's amazing, man. Well, the next topic really, that's like something I'm super interested. I want to talk to you about is like I just wanted you to talk about the retirement saving because that's like such an important thing. And there is so many things around it. So I just want to kind of pick your brain on that. If you can just kind of discuss that with us about the retirement saving, what are the different things like the 4K, the IRA, the Roth IRA. Let's just talk about that. Just kind of give us some definition of it and what the difference is, the benefit of it. Just kind of talk to us about that a little bit.
Yes. And I'm glad you brought that up because one thing is, especially the retirement saving, is dentists and medical professionals are typically 4 years behind their undergrad peers. So that is a way you really want to start catching up on. To start, I think it's probably best to just start with the IRAs. So there's essentially two types of IRAs. It's going to be a traditional IRA and a Roth IRA. A traditional IRA is tax deductible, so you can remove that in the current. If you're under 50, the current maximum contribution a year is $7,000. And then you got so that's going to go in after tax. It's going to be tax deductible. And then that grows tax deferred until you take it out, which you hopefully aren't taking out till 59 and a half because there are going to be penalties if you do.
Uh-huh.
So these are retirement accounts. You're really not supposed to touch these until then. There will be taxes and penalties implied. But you defer that all the way up to 59 and a half, hopefully. But when you start taking it out in that retirement phase, hopefully in that later part of life, you will pay taxes on whatever you did not put in.
Oh, wow.
That's important to keep in mind. Now, the other option is a Roth IRA. And so Roth IRA is actually going to be after tax dollars. So you put $7,000 after tax in, and that grows tax free. So anything that you put in, assuming you wait and follow all the guidelines along with it, you can actually take it all out tax free, including the growth and everything. So it's kind of, do you want to save the taxes now, or do you want to pay the taxes now and take the growth later? And everyone's circumstances are different depending on your tax brackets and your income there. And then one thing to keep in mind with the Roth IRA, though, especially for dentists and kind of high income earners, there is an income limit, which is currently in 24. It is $146,000 if you're single, $230,000 if you're married, if you're filing married. So that's important to keep in mind too. So you can't contribute. However, and again, it would really depend on circumstances. You might be able to look into a backdoor Roth IRA, which is essentially a way to contribute if you are over the income limit. Again, I would defer you to talk to someone to kind of go over those details. Go ahead.
No, go ahead, please.
I was just going to forward that into now you can go. So those, again, you're kind of limited with only a $7,000 contribution. However, if you're employed, hopefully your employer and you have a 401k plan at your employer, and then you can put in $23,000 a year, which is obviously significantly larger. Similar, depending on your plan, you might have the option of a traditional 401k, which is similar to those traditional IRAs, tax deferred money. You're not paying taxes. So you have to put $23,000 deferred off your income, or you can go into the Roth 401k, which is again going to be after tax dollars, but then it grows tax free. You can take it out of those. And hopefully, and it depends on the situation, sometimes employers do offer matches with those as well.
Now with the 4K, just to kind of get an understand. So with the 4K, is that tax free as well, or do you pay the taxes when you take the money out? At 59
it depends on which one. So the traditional 4K is pre-tax money. So if you contribute $23,000 in your traditional 401k, that's not going to be taxed as income. However, you can do the Roth 401k if your provider allows for it, which is you're paying after tax dollars and that grows tax free. So the Roth 401k, when you take it out, assuming you follow the requirements, it's going to be tax free. The traditional IRA will have taxes when you take the money out.
Is that at the 59 and a half that you still pay taxes on that money that you take out?
For a traditional 401k, you'll pay taxes no matter what when you take it out.
Gotcha.
However, if you do it before 59 and a half, you will pay penalties as well.
I see what you're saying. But if you wait till then you don't have to worry about that.
Exactly. If you wait till 59 and a half, you just are paying the taxes because you've done the waiting requirement. Because these products, these different investment vehicles, whether it's an IRA or 401k, were intended to give you kind of tax benefits for retirement. They are individual. IRA stands for individual retirement account. So they're created for retirement. They don't want you digging into those, and they're going to try to penalize you if you do actually. So you really don't want to touch those until at least 59 and a half, hopefully even later. And kind of one of the schools of thoughts with this is at 59 and a half or later, hopefully you're in retirement, you're at a lower tax bracket. So then you're kind of thinking, am I winning by deferring the tax later because I'm in a high tax bracket right now? Or do you want to just get it out of the way so you have it all tax free down the road?
Wow, that's amazing, man. That's like the stuff that is just like mind blowing with how there's just so much stuff going on with that. Before we move on to the next thing, I do want to ask one more thing about the 401k. So let's say let's get 20 years from now when I'm like, want to retire or whatever, does the inflation kind of affects that amount at that time? Because as you know, the inflation happens and things like that. Does that affects how at the time when you want to retire, does that have any effect on that dollar amount?
And what do you mean on the how much you can contribute?
Yes.
Yes. So so the government has increased these contributions over the years. I actually remember when I first started in the industry, it was $20,000. So it has increased over the years. How they'll do it varies year to year. They don't have, a set, they kind of, to your point, will review inflation and see what really makes sense there. So there's nothing set in stone, but every year they'll come out and announce new numbers, and typically those could increase, but you never know.
That's amazing, man. Well, the $1 million question for all of us as a dentist, medical doctors, what we really need to consider when we're trying to purchase a practice, because that's really the part that we're like essentially stuck on, right? All the time we're saying, oh man, we have all these student loans, we have all these responsibilities. Like, at what point should I say, okay, I want to purchase a practice? When is that?
Yeah. And just going back to the same thing with the 401ks, IRAs, you're probably going to get sick of me saying it, but it's really, unfortunately, there's never black and white answers in financial planning and working with individuals because everyone's got a different situation. I would say you really want to focus on paying down that debt first so that you have that opportunity to hopefully purchase the practice. Ideally, you paid off that debt and now you're saving for that practice purchase. You're most likely still going to have to finance it. Every deal could be different. It could be a payout over time. It could be a cash payment. It really depends on what that person selling it to you wants to do. So again, there's no right answer. However, you do really want to work on getting out of that debt so that you have more opportunity to purchase it and for your financing. But then once you do purchase it, then there's all kinds of different topics you can kind of dive into. For example, going back, and the nice thing about finance, everything does kind of intertwine, but now you're going to be the person choosing the 401k plan for you and your employees. And then that's really just, you really want to work with an advisor who's gonna work with you and your employees. So an advisor hopefully will be meeting with those employees of the plan and help them guide them on what those investments should be inside of the 401k.
Wow, that's amazing, man. And then now going to that, kind of like following with that one, as far as like the purchase of practice, what is like the cash balance plans and all that we sometimes hear of? Like, what is that? Just kind of talk to us about that.
Sure. Again, so a cash balance plan actually is an arrangement, an IRS tax qualified hybrid retirement plan. Now that sounds kind of jargony, but it really combines high contribution limits of a defined benefit plan and a simplified contribution formula and portability of a defined contribution plan. So it's typically paired up with a 401k and a 401k profit sharing plan, and it's going to really maximize retirement strategies and tax deductible contributions. As again, dental and medical professionals are kind of behind on their retirement, but then you go from zero to really a large income. And if you purchase a practice and it's a smaller practice, if you implement this plan, and again, it really depends on the size of the practice, but you could defer anywhere from up to $160,000 to $380,000 depending on your age. So think about the idea, if you're a business owner and you're making $600,000 a year, the tax savings you can have in deferring $380,000 of that off of your taxable income for the year. So it's definitely a great tool. It's a little complicated, as you could even hear in the definition. but it is a great tool for that tax deferred savings if you really wanted to explore how to really increase the retirement bucket. But yeah, it's a fantastic opportunity.
That's amazing, man. That's a good stuff right there. And really, just kind of close things up. I mean, I so far love the amount of information that I received here, and I think other people will enjoy it too. But just want to kind of close things up by just really asking you, like, when you're trying to really, because as you know, there's a lot of financial advisors out there, and they each have, something that they can offer you or give you some value. But really, how do you, when you're looking for financial advisor, what are some of the things that you should ask, or what are some of the things that you should look into, and how do you really pick one?
Business.
In the world that we're in. So how do you really pick one, and what are some of the questions that we should be asking?
Yeah, I always say my general advice is go with your gut. Ideally, when you're working with an advisor and you pick that advisor, you're going to be working for a long time. We have some clients that are we're on the third generation of that family. So you really want to have someone that you can trust, that's going to care about you for the long term and not just for a one-time sale. That's really my general advice typically. And you're never married to them. You can always change them if you didn't like what was going on. But I always say go with your gut, go with someone that you like and you think is someone you can trust with your finances.
Man, that's amazing, Michael. This is such an important topic for all of us, especially for me. Like I said, I graduated dental school not long ago, and I think that the financial knowledge is so little when you get out of dental school. And I'm sure other people probably feel the same way. And we go through so much trial and error trying to figure out how do you really maneuver the industry and figure out what's the right things to do. And I think this conversation that we're having is so important for the long-term financial success of everybody, essentially, dentists, other people. I think it's so important for us to bring about the knowledge so that people have a better understanding, because truly the world of finance is so big and it's such a huge industry and has so much the laws and the regulation, and sometimes it's hard to understand. So I think that you guys do all of us a service by taking that off our plate. So it's definitely one of those things.
Yeah, and that's the goal. My family I grew up in a family business, actually an insurance business, and my family knew insurance but didn't really know the financial side. And exactly the point is hopefully trying to help people like dentists or really anyone just understand and simplify, because it's such an important topic in your life.
It absolutely is, man. It absolutely is. Well, Michael, I want to thank you so much for taking the time. I know it's late in Boston. It's probably cold.
Yeah,
You got on this call.
It's going to be a cold walk home. I do need to put in my disclaimer so that
Yes,
this can
please.
get posted by compliance.
Yes.
Also, if anyone has questions or wants to follow up, I'm sure you'll be sharing this on our LinkedIn, but you can always message me on LinkedIn if you want to connect. But my fun disclaimer, just so everyone can be happy here. The concepts illustrated here have legal, accounting, and tax implications. Neither Janney Montgomery Scott, LLC, nor financial advisors give tax, legal, or accounting advice. Please consult with the appropriate professional for advice concerning your individual circumstances. For more information about Janney, please see Janney's Relationship Summary, Form CRS, on www.janney.com.
That's amazing, man. You went through that really quick. I love it. I love it. I enjoy those every time I get on, and I'm like, put the disclaimer. This is not a financial advice. So I'm like, all right, do it.
Yeah.
That's amazing. That's amazing, man. Well, Michael, I thank you so much. I enjoyed our conversation. I hope you come back, see us again. I really enjoyed this. Again, if anybody wants to find Michael, he's on LinkedIn. I will put all his information on our bottom of the video. Please find him, ask him questions, pick his brain. Hopefully he can help us along the way as well. Michael, thank you so much for your time.
Yeah,
man. I really
thank
appreciate
you.
it.
Looking forward to be on again.
For sure. Thank you.